I'm speaking with Andrew McVeigh, Managing Partner at Remara. First of all, Andrew, thank you so much for participating in the Inside Network's Income and Defensive Assets Symposium.
No problem, James. Thanks for having me.
Great pleasure. Having navigated both corporate balance sheets and private wealth portfolios, Andrew, how has your background in investment banking shaped your philosophy on income generation for wealth clients in today's market?
Yeah, look, I think it's a really interesting question. There's a number of different opportunities out there. And if you look through a number of different asset classes within credit for income generation, you've got real estate-based credit, you've got corporate loans, you've then got securitized credit. So what we've really done and what's influenced my approach in terms of looking at creating income is what do investors need at different life cycles of their portfolio. So yeah, if you are younger, you're in the accumulation phase a little bit more, you're looking to take a little bit more risk in your profile. And that just not only includes equities and crypto and other asset classes you might want to invest into, it's also within income generating assets. And that's where we've created a series of funds that are higher risk profiles, but also have funds for people that are in that preservation stage where they want kind of a medium risk profile with some better access to liquidity, and then guys that are in that retirement phase where they want lower risk profiles and really strong liquidity access. So a lot of what we've done is been influenced over different asset classes that provide, and particularly different credit asset classes that provide different attributes that should be used over a life cycle of investing, not used through the entire life cycle of investing.
Remara offers access to private credit, structured debt, differentiated fixed income investments. What guidance do you give to advisors in today's environment in terms of balancing yield opportunities with liquidity and the ever-present responsibility they've got to think about downside risk?
It's a tough one. There's a lot of things on that list there, and I think one of the biggest challenges is credit as an asset class is by nature fairly opaque unless you're in a totally listed vehicle or a totally listed asset class that's daily traded. I think what I'd say is understanding investors' needs around that liquidity is probably their first and foremost. When you're talking to managers, you want really to be able to ask three questions. How much skin in the game do they have, particularly on credit? Credit is naturally skewed towards the downside, so your upside is limited by the return profile. So if it's a 10% interest return, all you're going to earn is 10%. But your downside is everything that you invested into that loan. So with that, return being skewed towards the downside, you really want to know where the manager has their capital. Are they invested in that pool? And what is their skin in the game? Second question is how are they remunerated? Are they just earning fees off the back of it and have no ownership or no skin in the game? Are they getting default fees, establishment fees? What are they earning off of that profile? And then third question is what's their historical loss rates? What kind of sits within those portfolios? How have they gone through cycles? And who else invests in those portfolios? If you're investing in a portfolio where it's only retail investors or private wealth and there's no institutional capital in that strategy, might not be the best in terms of overall security and validity, because institutional investors have the ability to dictate further information and more granular information. So if you find a portfolio and find a manager that has institutional investors in it, it's generally a pretty good sign. It stands up to that rigor.
Andrew, in your view, which segments of the income and credit markets are most overlooked by wealth managers, and why should advisors be paying close attention to that?
Yeah, look, I think real estate has been around for a long period of time now from a credit perspective. So if you look at the history, post GFC, a lot of banks moved out of construction development loans, so they moved out of that direct real estate lending. So that has been a fairly mature market now. There's a lot of people that have invested into that. Corporate lending is probably a medium term. It's been around now for a number of years, pre kind of 2020 COVID. And as a result of that, it's probably got the second most allocation towards most investors' portfolio. You then start to look at asset-backed finance, and that's essentially securitized or structured credit. That has probably a small allocation towards most advisors' portfolios for their clients. But I'd probably argue it actually is the one that should have some of the highest allocations. And that's based on the underlying mechanics of that asset class. It's got amortizing cash flows, self-liquidating. There's a lot more controls, portfolio oversight. That natural principal paydown means there's a lot more embedded liquidity. It's contracted month in, month out, and generally you've got independent trustees that are managing and overseeing the cash flow waterfalls, the performance of the pools, and essentially they provide that independent guidance there and also provide a bit of oversight in terms of valuations on a monthly basis. So I would say a larger allocation towards structured and securitized credit is something that most wealth advisors should look at. It creates a really good, strong cash-on-cash yield. There's no, writing a loan and then there's no kind of income stream, no interest, and then essentially a big bullet repayment. It's principal and interest every single month. So the cash-on-cash return is really, really strong. You're not taking a lot of capital risk, there's no capital appreciation that's embedded that. There's no warrants. There's none of that other stuff that goes into kind of more high yielding and opportunistic strategies. So it's good, strong cash-on-cash yield with true traditional underlying cash flow that's paid month in, month out.
What conversations do you believe advisors should be initiating with asset managers right now to ensure that they're properly evaluating the risk and sustainability of income strategies that they've implemented across their client portfolios?
Yeah, it's a really good question. I think some of the challenges that we've got is there's 300 credit funds in the Australian market. There is a strong flow of capital into credit funds, but there isn't as many high quality credit opportunities to invest into. So understanding how a manager originates that credit, where they get it from, how aligned they are to that, I think will have a really strong view and provide a lot of guidance as to who you should be investing with into the future. If you're investing traditionally solely into real estate credit, and you've got customers or clients that have a lot of real estate exposure from an equity perspective, you are very heavy into the real estate market and probably overweight in terms of an allocation to the real estate market. So I think looking at alternative forms of credit at this point in time is pretty important, but also understanding how does that credit get originated, how sustainable is that origination channel, because you don't want to invest with a manager that's essentially sitting on 30% cash because that's eroding a lot of your return.
Given persistent inflation, rate volatility and bank retrenchment from lending markets, how can you help advisors and other clients contextualise those sorts of macro shifts into actionable portfolio decisions?
Yeah, I think a lot of, and particularly regulatory change is driving a lot of the Australian private credit market. So you've seen Basel III implementation for Australian banks in January 23. That has led to a big shift in terms of what gets originated out of banks for securitized light credit. So this is mortgage loans, car loans, truck loans, those types of things. There is a lot more of a permanent shift towards that being originated outside of banks and banks coming in and funding it, but not originating it directly. That is a permanent shift. We're in the tailwinds of that now. That market will grow fairly substantially. And that's probably one of the last markets in the Australian economy where you'll actually have fairly substantial growth in credit leaving the banks. I think the real estate market, particularly construction and development, that is now a very mature market. You'll see a lot of consolidation. But I think in the more ABS or securitized structure, you're going to find a lot more of that flow now in non-banks, and that means there's going to be a lot more asset-backed securities, a lot more structured finance that makes its way through to end investors. From a regulatory perspective, I think that's quite favourable. There is more governance that's applied to those types of structures. As I said before, there's a lot of cash flow that goes through. It's all contractual. It's not relating on value being added to an asset and one bulk repayment. You've got natural depreciation and natural cash flow streams that come off the back of it. So I think that's a superior asset class, particularly for retail investors and wholesale investors that want to generate yield but still need the ability to be able to have good, strong liquidity attached to it. We like securitized credit for the cash-on-cash yield that you get from it. So essentially, you've got a really strong credit profile, but you're getting cash month in, month out. And that is very valuable because you never know when you need to have that cash. It means that we can redeploy that cash into new assets. We can re-weight the portfolio if we're seeing macro or micro trends that we're not really comfortable with, or we could provide liquidity if we have investors that are needing that liquidity in those liquidity windows we offer.
Andrew McVeigh from Remara, thank you very much for your time today.
No worries. Thanks, James.
you.